I'm Osborne Foreman. In this video, I'm going to analyse Unilever stock by giving my thoughts on the business and whether I personally would buy shares of Ulvr right now. And if you find the video useful, please drop one of these to support the series. Unilever PLC is a consumer goods company with a large variation of brands and labels in different various segments, such as beauty and personal care, foods and refreshments, and home care. They have a wide range of brands going from Dove, Tresemme, Vaseline to Ben & Jerry's, Magnum to also Domestos and also Persil. Ulvr is listed in the FTSE 100, has 150,000 employees and a market capitalisation of £104 billion. I believe that Unilever is in a fragmented competitor landscape and in an oligopoly market structure. This means that whilst they are market leaders in specific industries, they have no additional marketing influence over their competitors. Furthermore, due to being in a fragmented competitor landscape, it means that whilst they can be market leaders in some industries, it may be difficult to track where they stand overall. Despite this, I would consider their closest competitors to be Procter & Gamble and Colgate-Palmolive. If that's how you say it, I don't actually know. Although whilst I believe that these two firms are certainly their closest competitors due to being widely available in developed markets, I believe that Unilever is more at risk to those in the emerging markets, and therefore new and upcoming brands in those respective markets may provide more of a risk, as Unilever has a majority of their revenue allocated into the emerging markets, and they want to further increase this exposure because in the future they believe that 80% of the world's population will be in the emerging markets. And therefore these local competitors are certainly more of a threat, and it may be more difficult for Unilever to build up brand loyalty. And so we could also expect that pricing may be more competitive in these emerging markets, as currently they may have lower ability or lower disposable income, and also their branded or their competitors may also be quite strict on pricing, and since they are in the growth stage it may be a lot more fierce and lower margins, for example. When looking at Unilever's most recent financial results for the year ending of 2020, we can see that their revenue has decreased by 2.4% compared to 2019. However, they attribute this due to a 5.4% loss in currency impact, which could be a continuous concern in the future if a majority of their currency continues to be devalued like it is. Furthermore, we can also see that their diluted earnings per share has decreased by 0.9%, suggesting that this isn't just a currency impact. On a more positive side, we can see a substantial increase to their free cash flow. It's increased by 1.5 billion euros to 7.7 billion euros. I believe that's a brilliant free cash flow to have. Although in the last 5 years, they've only managed to increase their earnings by a compound annual growth rate of 6% per year on average. And in that same time, unfortunately, revenue has remained very stagnant. And whilst I believe that becoming more profitable is a very good thing, I also feel that it's not sustainable without consistent top-line growth of revenue, and so it might put things like the dividend at risk, which smoothly brings me on to their dividend, as they are well known as a dividend payer, and it could be a risk if they're unable to continue growing. Unilever is currently yielding 3.67% and pays quarterly, which is very rare for a UK stock, typically paying in September, June, November and March each year. And if you'd like to sign up to a stockbroker, you can use Freetrade using the link in the description down below, and then you'd be able to buy shares of Unilever if you wanted to. In the last 20 years, they've managed to grow their dividend every single year. Whilst in 2009 it might look like a dividend cut, and that would make sense during the great financial crisis, this is not the case. In fact, this is them converting their dividend payment currency from pence to euros, and so due to currency conversion, it probably may look like a cut, but going forward, that wasn't really materially relevant. But this does mean that if they do pay their dividend in euros, which they currently do, that if you use a broker like Freetrade, which I mentioned earlier, FX fees may eat into your dividend payments, so it's worth keeping that in mind. In the last 10 years, they've managed a compound annual growth rate of their dividend of 7.14%. And I think this is very respectable and very much outweighs inflation or the target of 2%. In the last year, though, they've only grown their dividend 1%. That's because they maintained their dividend throughout the pandemic, and then only in Q4 did they grow it by 4%. However, they also have a considerably high payout ratio of 77.7%. Whilst you could argue Unilever is a very mature, well-diversified business, and therefore putting more money back into the business for growth may be unsustainable and not worth the additional money, and therefore shareholder value may be better increased by putting more money into the dividend. But this to me is more on the riskier side, and as we've seen, if they're unable to continually grow their earnings at a faster pace than their dividend growth, then either the dividend growth is going to substantially slow down, like we've only seen 4% this year, or we may see a dividend cut in the more distant future. And especially when we compare the last 5 years of earnings growth, which is around 6% CAGR, to the last 10 years of dividend growth, which was 7.14%, that's obviously unsustainable, and it really depends on whether they're able to continue growing in the future. When looking at the balance sheet of Unilever, we can see that it is in fact of poorer quality. This is because their short-term assets do not outweigh their short-term liabilities or long-term liabilities, which when combined with their high debt-to-equity ratio of 144.6% really does make a poor balance sheet. Furthermore, whilst they have a respectable cash position of around 6.3 billion euros, this only makes up less than 25% of the overall debt. Although due to their higher cash flow, one could argue that their debt is more sustainable, as in an unrealistic situation, they could pay it off in a few years using all of that cash flow. But as I said, it's unrealistic, but at least it's not unsustainable levels of debt. The concern with Unilever that I have is whether it's really worth owning a brand or simply owning a retailer. And that's because I believe in this current day and age, brands don't have much control. I feel that a lot of the control is with the retailers. After all, if you are putting Unilever's brands in a supermarket, this supermarket can control a majority of the pricing. They can also control where they place this brand. If they place it in a hard to see, hard to reach shelving location, then it's very likely they'll get a reduced amount of sales from that supermarket. And also, supermarkets or retailers, could create close competitors. They might create their own brand, like we have at Tesco Value, for instance. They could then place this in a more prime location compared to the likes of Unilever's, and therefore see increased sales for Tesco Value, which are probably also undercutting the price of Unilever. They could then use this as leverage to therefore negotiate, saying, look, Unilever, we're getting more sales with this, are you going to pay us more so that we can put you in a better spot? And therefore I kind of feel that brands are at the mercy of retailers, and so it might be more worth owning a retailer, for example. That isn't to say that brands like Unilever don't have competitive advantages. Like, for sure, they do have flexibility over choosing which retailers they would like to have their products sold from. This can be advantageous, as they might be trying to reach a certain location or perhaps consumer target, and therefore selecting and choosing which locations to have their goods at could be on the positive side, and it gives them more flexibility in times of economic uncertainty, especially considering Unilever's brands are well known. People may be more reliant to trust these, and therefore in these times of recessions, for example, when money is more tight, they may stick to the well-known brands rather than experimenting on perhaps more expensive or cheaper brands because they simply don't know the quality of them. Furthermore, brands like Unilever are bigger. They're expected and they're able to probably easily distribute their products, and also means that they could produce more given a high pent-up demand, because they can have faster speeds of production as they likely have a lot more warehouses compared to the likes of smaller brands. Furthermore, it's probably expected to have a higher level of customer service, as they're a bigger business, they have more capital allocated to it, for example. And they could also probably use this extra spare capital for further advertisements, which, if you have looked on TV, which I don't really watch TV that often, a majority of the advertisements that I've seen personally in UK have been Unilever. And you'll see the little Unilever symbol at like the top corner of the screen at the end of it, and you think, oh, I didn't know they own this brand. So that certainly instills the idea that they do have a moat and that they are quite well known. But it really depends on whether you want to buy a brand or a retailer, as I had mentioned. At least in terms of a brand, you could probably rely on Unilever over the likes of smaller brands, but then again, these smaller brands, if they're able to claw up market share, they may offer more financial growth than the likes of Unilever. After all, in the last 5 years, Unilever has rewarded shareholders with returns of 52.8% with dividends reinvested, which whilst beats the market, it may not be other smaller cap in the industry. In my opinion, I think Unilever is a fitting stock in an income portfolio for those that need dividend income. Therefore, if you're nearing retirement or are in retirement and you're looking for dividend income and a stock that's likely to preserve your wealth but also grow your capital, then Unilever probably is a good idea. But then my concern really comes to their high payout ratio currently. And if they're able to continue growing, or if they're able to reverse this negative trend that they've had in the most recent year and continue growing, then this could be a great investment with a very reliable dividend history. However, if they don't do this, I feel that it's going to become a lot more uncertain, and investors don't like uncertainty, and that's probably why the share price has dipped a fair amount. And I think the uncertainty comes into whether they will be able to maintain growing their dividend at the current rate if earnings are less, and also whether they may cut the dividend in the more distant future if this is unable to be achieved with earnings growth. On the other hand, whilst it is potentially at risk of dividend cuts, we could also argue that if the emerging markets do well in the future, as they make up a majority of the population or will do, then this could be very advantageous as Unilever has a large stake in them, and that would see a more future-proof investment, and therefore it could be more likely for them to grow on their financials. More recently, they have transitioned to more of a growth approach. This can be seen in various updates that have been released from the company, and this strategy may prove more advantageous for long-term holders, and therefore that exposure into the emerging markets could be good for those looking to diversify their portfolios but also future-proof it somewhat. It really depends on the short to medium-term risks versus that of the long-term potential. According to my poll that I had posted on Monday, it seems like a slight majority of the community would buy Unilever instead of selling. I personally have held shares of Unilever in the past, but I ultimately decided to sell. This is because it doesn't reflect my strategy. I'm young, I'm only 21 years old, and therefore at my age I don't need dividend income. I'm likely going to be working for many more years to come, and so that income on the side isn't as important to me. Rather, I should grow my smaller amount of capital, invest in riskier assets that can do that faster, so that once I do get to the age of retirement, I could then preserve my wealth with dividend income and also slightly grow upon it. Therefore, I had sold Unilever shares. But I do see the value if you are seeking income, especially in the UK, nearing 4% yield, quarterly payments. You really can't complain too much with that, and it is of a lower risk compared to other FTSE 100 companies. Although after their more recent dip, I could see an opportunity, and if they are able to effectively transition the business, grow up on the financials even slightly, I think that this could provide an opportunity to get in at a good price and hold for the long term. If you're interested in how I got suspended from trading 212, then click the card at the top right of the video. Thank you for watching, have a great afternoon.